Assalamualaikum. My name is Nur Syahira binti Nazaruddin and I am from JBA 2423C. So today I will present to you about the capital structure. So let's begin.
Capital structure is referred to as the relationship between multiple types of long-term funding such as equity capital, preferred share capital and also debt capital. Capital structure also are referred to the type of security and the total proportion that makes up the capital. Bogan has said the capital structure may consist of one class of shares or it may consist of numerous issuers of bonds and preferred shares with significantly different characteristics. What is capital structure? Capital structure of a firm refers to the unique combination of debt and equity which are used to fund its assets and activities, which is operations. Equities will operate as a more expensive sources of permanent capital with greater financial flexibility from a financial corporate perspective. On the other hand, debt is the total opposite. It will represent a less expensive, finite to maturity source of capital that legally binds to the corporation to a fixed, guaranteed cash outflow with the requirement to refinance at an unknown cost at a later or future date. Then, how can we determining optimal capital structure? Calculating a combination of debt and equity that reduces a company's weighted average cost of capital, which is WACC, while maximizing its market value yields the optimal capital structure. The bigger the present value of the firm's future cash flow, which are discounted by the WACC, the lower the cost of capital. So, there are a few steps in order to determining optimal capital structure. So, the following steps are: the first step is find different capital structure with debt equity ratio. We will calculate the debt equity ratio to help us to be more understand the capital structure. The debt equity ratio will be debt per equity. For example, if we have $19,000 in capital and $0 in debt, our debt equity is 0 per 90. As a result, changing the value of share capital and debt could result in millions of different capital arrangements. There will be the same number of uppercase values. The second step is find the cost of capital and cost of debt at different level of capital structure. The dividend rate is the cost of capital and the interest rate on borrowing is the cost of debt. Both the cost of capital and the cost of debt will be low if the risk is low. However, as the risk of loan payback rises due to higher debt sources and lower capital resources, both the cost of capital and the cost of debt rise. The third step is find the weighted average cost of capital, which is WACC. A more appropriate result will be obtained using the weighted average cost of capital. So, we will compute WACC, which is the same as the average cost of capital, but we will use the product of the cost of capital to the debt equity ratio. So, the last step is reach optimal level of capital structure through graph. We can attain the best level of capital structure by graphing the cost of capital, cost of debt, weighted average cost of capital, and debt equity ratio. This is the most efficient capital structure. There are a few factors that give impact to the capital structure. The factors are: the first factor is company life cycle. Companies usually grow from time to time and there will be a change among consumer, which is a change from a cash consumer to a cash generator. With these changes and developments, it will reduce business risk and increase debt capacity. Thus, a company will be more advanced and become a stronger competitor to other businesses in the same industry. The next factor is earning. Business with higher income prospects can incur these fixed finance charges and avoid having high debt value because debt repayment are periodic with fixed interest rate. Companies that face higher sales volatility or have less stable results, such as consumer goods, will be more reliant on equity stocks to fund their operations. The third factor is risk. Two risk aspects, which are business risk and financial risk, are addressed in capital structure decision. Due to their income fluctuate significantly, businesses with high business risk tend to have a lower debt levels. Meanwhile, due to the risk of variance in predicted earning is lower, firm with a low level of business risk may have a bigger loan component in their capital structure. The last factor is business size. The capacity to raise capital is influenced by the size and the scope of the company. Long-term loans are tough to come by for small business. As a result, creditors will be hesitant to lend to them since the value of their business activities is too small and will put creditors at risk. What is financial distress? Financial distress occurs when a firm or individual is unable to earn sufficient money or income, resulting in the inability to fulfill or pay their financial responsibilities. This is usually due to high fees expenses, significant amounts of illiquid assets, or recession-sensitive rates. Examples of a firm's expenses that must be paid may include financing such as paying interest of debt, opportunity cost of projects, and employees who are not productive. Employees of a distressed firm usually have lower moral and higher stress caused by the increased chance of bankruptcy, which could force them out of their jobs. Meanwhile, individuals in financial distress may find themselves in a scenario where the expense of repaying their obligation exceeds their monthly income. Individuals may have financial difficulties as a result of bad budgeting, excessive spending, high debt levels, lawsuit, or job loss. So, they may be forced to give up assets secured by the obligation such as their home and car. So, next is integration of tax effects and financial cost distress. Financial cost distress is the expense of a financial distress situation in which a corporation is unable to repay its obligations and responsibilities. Costs linked with financial difficulty include indirect fees, conflicts of interest, bankruptcy costs, and greater capital costs. To finance their activities, businesses take on debt based on short-term or long-term profits. According to Modigliani and Miller, the presence of a corporation tax debt increases the firm's worth, while some financial analysts and professionals believe that the cost of bankruptcy can cause the firm's total value to drop. A company's worth rises when it moves away from equity and toward debt. Because the current value of the distress cost is negligible, the chance of distress is low in this case. As a result, every modest increase in debt value will raise in the current value of this cost. It will be accompanied by an increase in the current value of the tax shield in some cases. The tax shield will quickly accelerate bankruptcy, resulting in a devaluation of the company. Above is the graph which shows how tax effects and the cost of financial difficulty or distress are combined. So next is agency cost of equity. Conflicts of interest between management and shareholders are referred to as agency equity costs. The cost of agency equity arises when management makes decisions that are not in the best interest of the company and are perceived by shareholders as activities that will not improve the value of the shares. There are three situations that agency cost of equity caused by. The first situation is shirking. Shirking is when a company begins to borrow money from the market to finance its operation with debt rather than interest, so the owner's equity will fall. When equity is replaced with debt, the owner has additional incentive to shirk. So, the next situation is perquisites. The cost of equity of the agency is also represented through perquisites. It is, in essence, a direct advantage to the business owner or entrepreneur. Perquisites include things like free cash flow, the use of business cards, and other assets for personal advantage. So, the last situation is bad investment. Unprofitable ventures, on the other hand, can cause problems on a company's finance and put it at danger. Investing in the wrong project can lead to the company's collapse. When a corporation makes a poor investment, shareholders will do everything they can in order to prevent a situation like this as the cost of agency equity rises. So, the next topic is pecking order theory. Pecking order theory was first proposed by Donaldson in 1961 and it was modified by Stewart C. Mies and Nicholas Metcalfe in 1984. The theory states that when managers, the person who are assumed to know more about the actual state of the firm than the investor are issued new equity. The investor believes that the manager believes the firm is overvalued and the manager takes advantage of this overvaluation. As a result, future stock issuance will be valued lower by investor. The principle of asymmetric information gives rise to the pecking order theory. Information asymmetry, often referred to as information failure, happens when one party has better or more information than the others, and it is resulting in a power imbalance in the transaction or a company. So, as an investor, have to make a right decision and choose the potential company before investing in any company, and they can evaluate just by using pecking order theory in order to know information about the company itself, whether the company in good or bad conditions. So, the last part of capital structure is signaling hypothesis. The asymmetry of information between management and shareholders give rise to signal theory. If executives believe their company is undervalued, they will first issue debt and then equity as a last resort. However, if the management believe their company is overvalued, they will issue equity first. The first signal theory contends that if managers have inside information, their capital structure selection will indicate that information to the market. The firm's capital structure is optimum when the debt's marginal subsidy match with marginal cost. Debt is viewed by investors as a sign of a company's worth. There are two requirements. The first is when a company with low profit expectation takes on a little amount of debt. The second scenario is when a company with strong profit expectation takes on a lots of debt. A management who takes on more debt than is necessary in order to trick investors into paying higher long-term costs. Dividend signals are theories that imply a company's announcement of a dividend increase suggests a strong future outlook. This hypothesis is linked to a game theory concept that managers with strong investment potential are more inclined to send good signals, while those without such prospect are more likely to give bad signals. Despite the fact that the concept of dividend signals has been widely questioned, some investors still believe in it. If an organization receives a dividend signal, sales may increase. But nevertheless, if the company later discovers an accounting error, scandal, or product recall, revenue may incur unanticipated losses. As a result, dividend signals may predict increased future earnings as well as higher stock prices. However, this does not rule out of the possibility of negative occurrences occurring before or after the revenue distribution. That's all from me. Thank you for listening and watching.